Hi everyone, it's Rich Warner from wealthmaxbuilder.com. This is video lesson 3, section 3 from the Essentials of Investing video lesson series. We're in lesson 3 where we're talking about dubious investment ideas you should avoid. In the previous lesson we talked about individual stock picking and value stock picking strategies. In this video, I'd like to focus on dividend capture strategies and convertible bonds. Please have a moment to take a look at the copyright notice and the disclaimer statement. Thank you very much. You know, in this day and age with treasury yields and CD rates as low as they are, providing yields that are lower than the rate of inflation, there is this yearning or hunt for high-yielding securities. And people are starved for yield. Over the past few years, we've noticed that investors are willing to assume much more risk than normal in order to achieve those higher yields. And there are many ways they're doing it. And these are strategies that in most cases you should be very careful of. The first strategy I'd like to talk about in this video is the dogs of the Dow strategy. Now this is a strategy where you take the highest yielding Dow Jones Industrial 30 stocks. Okay, so the Dow Jones Industrials is comprised of 30 stocks, the large cap stocks of the US market. And essentially you rank or sort these 30 stocks by their yield, their dividend yield, by the amount of the dividend that is paid out, usually quarterly, and you add them up, the 4 quarters, and you divide that summation by the stock price. And that's the dividend yield of a stock. Now the dogs of the Dow strategy sorts the Dow 30 stocks at the end of each year, or at the start of each year, whichever, and you're basically going into the first week of January every year with the 10 highest yielding Dow stocks. And so it's a value type of strategy, and it's also a search for yield strategy. Now in this table, I've basically summarized the performances of 2 value strategies against some interesting benchmarks. So how well did the dogs of the Dow strategy do between 1998 and 2016? Well, as you can see, the total average annual return of the dogs of the Dow strategy on a nominal basis was 8.2% per year. The real return was 5.2%. That's after inflation. The risk level was 16.5%. So if we divide the real average annual total return by the risk level, we get a real reward risk ratio of 0.31, which versus the S&P 500 is actually higher. So, you know, this is a preferable strategy to the S&P 500. But against the total market index, which is the ETF VTI, which is the combination of the large caps, the mid caps, and the small caps, the broad market index, if you will, it underperformed. The total market index, VTI, over the same period of time, generated a 6.1% real return with a risk level of 17.2%, which translates into a real reward to risk ratio of 0.35, which is preferable to the dogs of the Dow strategy. So what's so great about the dogs of the Dow strategy? It really isn't that great of a strategy, especially when you compare it to the mid-cap value index, which has generated a real reward to risk ratio of 0.54. So mid-cap value is not a bad place to be if you're a passive investor. That's one of the lessons we could take away from this analysis. Another strategy I'd like to mention is what I refer to as the blown out sectors strategy, which is a strategy that was developed and promoted by my superior at the time. I worked for him, and he was really big on this concept of you take the worst performing industry sectors of the S&P 500 over the past 5 to 10 years, and he would select basically the top 3 to 4 sectors and go with that for the coming year. Now this strategy can be viewed as high yield. It can also be viewed as value, a combination thereof. So let's see how it's done over the same time period. Well, it generated a pretty high percent return per year, but it had a very high risk level, and it resulted in a real reward to risk ratio of 0.44, which is definitely better than the VTI, the total market index. But again, it too does not outperform the mid-cap value over the same time period. So you could have saved yourself a lot of time and hassle in trying to select, pick a portfolio of 30 stocks, let's say, that are comprised of these poor performing sectors, and make sure you update this every year, when you could have just simply bought the mid-cap value ETF, ticker symbol VOE, and got very, very good returns for a decent amount of risk. Now, in the search for high yield, there are even more dangerous strategies than the two that I just mentioned, the dogs of the Dow and the blown out sectors approach. And this is literally going in there and buying high yielding funds. Now, a lot of these are REITs. Okay, REIT stands for Real Estate Investment Trust, and these are portfolios that are comprised of actual holdings in real estate, either domestically and or worldwide, and they're looking for appreciation in the underlying real estate over time, as well as rental income. Now, you take a look at some of these yields here. These are the current yields of these funds, and you'll see some astronomical yields, like 12%, 9%, 30%, 21%. I mean, this is scary stuff. The question you have to ask yourself is, how do they get the yields so high? The answer has to deal with leverage upon leverage. Just like you can buy a home with a mortgage, and you're borrowing, like, say, 4 times your principal, your down payment, or 5 times, these fund managers do the same thing. They actually go out there and they borrow money to invest in real estate properties. And they not only do that, they actually borrow on top of it. So it's like taking out a home equity loan on top of a mortgage based on the equity in the property used as collateral. And that's how these fund managers are going out there, and they're getting these enormous yields. The only problem is that, in expansionary times, it's okay because your tenants are paying their rent and the prices of real estate is increasing. The only problem is that these particular funds have high volatility levels, especially during recessionary periods. As we experienced in 2008, when the real estate market took a hit across the world, mostly in the United States, the same sort of thing is reflected in the prices of these funds. They start to plummet by 50% or so and more because they are so leveraged. So volatility is enormous. The risks are enormous when you're going for these extremely high yielding funds. And so I do not recommend that individual long-term passive investors should go near these instruments. This is only for market timers and traders, if anything. You do not want to go for yield and disregard the amount of risk that's involved. I mean, this is scary stuff. Look at these yields. They're like 11.5%, 12.5%, 30% yields, 20% yields. This is scary stuff. Individual investors should not go near these securities because the volatility is enormous. So I wanted to show you some real-life examples of how volatile some of these high-yielding funds can be. I've selected a few from the list that we've spoken about. Let's take DBBR, the Brazil Currency Hedged Equity Fund, for example. According to my telechart program here, DBBR has a dividend yield of about 25.3%, which is absolutely insane. I just wanted to give you an idea about the price movement that we're talking about. Now, while this dividend yield of 25.3% per annum may seem to be extremely appealing, let's take a look at what is involved actually in terms of the price movement here. Here we have a chart from, and I just picked a weekly chart that spans 2014, 2015 as an example. And as you can see, according to my telechart here, the price movement can be extremely volatile. If we started from up here, let's say in October 2014, and let me just click and drag this down to about January 2016, you can see that that's almost a 51% decline in the price of the fund itself. So you may be getting like 25% yield per annum, but you're suffering through enormous swings in the price movement of the fund. So you have to ask yourself whether this volatility is worthwhile, and the answer is no. While the fund may give you this exorbitant dividend yield, the price movement is really very, very volatile. And as such, it is not suitable for long-term passive investors. Here we have the Credit Suisse Gold Shares Fund. It's a covered call ETN, for example, with very high yield. As you can see here, according to my telechart, this particular fund has a yield of 10.5%. But again, notice the price swings of the fund itself. We're talking about, a drop in this case from March 2014 all the way down to December 2015 of 29% or so. And again, while the dividend yield may appear to be very high and attractive, the price volatility is just enormous. So the yield is not worth the added risk. Now I'd like to move on to a concept that I refer to as dividend capture rapture. Because I've noticed over the years that there are some newsletters out there that claim that you can literally surf from stock or fund to fund in order to get the dividend and then move on to the next play. Much like a bumblebee would go from flower to flower to get the nectar. But in practice, this doesn't work either. And the reason is that the dividend payment is immediately discounted in the price. As soon as the stock or the fund goes ex-dividend, there is an adjustment in the price downward to reflect the dividend payment. So let's take this Brazil Hedged Equity ETF fund, for example. Now on June 24th, 2015, as an example, DBBR paid out a dividend. And if we go to Morningstar, we could actually see that on June 24th, 2015, the distribution was an income payment of $2.31, and the NAV price of the fund was $10.90 a share. So that's an enormous dividend as a percentage of the NAV. So it's about $2.31. Well, that is the amount of the gap down on the very next day, the day that the fund goes ex-dividend. Almost exactly the amount of the dividend payment. So this concept that you can go from fund to fund or from stock to stock in order to capture the dividend payment is just ridiculous. It's hogwash. And I just wanted to be clear about that. So stay away from newsletters and funds that claim that they can surf from fund to fund or stock to stock and get you the dividend and move on. That's absolutely ridiculous. It makes absolutely no sense. Now, while we're on the topic of dividends, I wanted to alert you to another concept because it can get some investors into some trouble. Now, a number of years ago, when I started out as an investment advisor, I made the mistake of purchasing the Aberdeen Chile fund because at the time, I felt that the Chilean market was severely undervalued, and this particular fund looked interesting because it paid a nice dividend. Now, what I soon discovered over the weeks that I held this particular fund, and this is something that investors should be aware of when it comes to dividend payments, that sometimes a dividend payment is not necessarily the yield or the income, the stocks inside the fund paying dividend income to the investors, but it's sometimes a return of capital. And this is a scary concept. Sometimes this return of capital can be destructive. It can be actually investor money that's being returned, investor principal that's being returned to the investor. And that's no use to an investor who's in it for the long haul. This concept of return of principal is interesting for some investors who are looking to reduce cost bases and is for tax purposes alone. But it's not useful for the long-term investor. And as you can see, Morningstar filters out the dividend payment and tells you whether it's a return of capital or if it's a long-term capital gain or a short-term capital gain. So you have to be careful as an investor. Double check the composition of the dividend payments. Is this fund returning capital as it has, as you can see here in the history of the Chile fund run by the Aberdeen company? This particular fund returns investor capital. And just to update you on what I ended up doing with that Chile fund, I ended up selling it because I was not interested in getting a return of capital, of principal. And instead, I ended up going with the iShares Latin America 40 ETF, which gave me a bit more broader diversification across Latin America while still giving me a decent dividend. ILF did have some exposure to Chile as well, which was interesting to me at the time. So let's summarize some of the key concepts that we learned in this lesson. We saw that value strategies like the dogs of the Dow investment strategy, as well as value screens in general, did not outperform their benchmark indices over long periods of time, especially when you look at them on a reward to risk basis. And instead, it was best to go with mid-cap value funds. Second, we saw that high-yield funds like DBBR and MORT, etc. give you high dividend yields, and that may seem to be very attractive these days especially. But remember that the price fluctuations, the NAV of the fund, is extremely volatile, thus making the dividend yield not worth the risk. Third, we learned that dividend capture rapture is a fallacy. The idea that you can surf around from stock or fund to fund in search of the dividend payments and just get on board just to get the dividend and then close out the position and move on to the next play, etc., is a fallacy. It doesn't work in practice because when the fund or the stock goes ex-dividend, the very open at the next day, the price is adjusted downward by the exact amount of the dividend at least. So there is no benefit to hop around like a bumblebee from flower to flower in search of the dividend yield. And finally, we learned that when it comes to closed-end funds especially, you have to be careful with dividend payments. Go to Morningstar and check out the composition of the dividend payments and see whether there's a return of investor principal. Because what use is that to the long-term investor if you're going to get your money back? When you want to be invested in a long-term play, don't you? What's the point of having your principal returned to you as a long-term investor? And that's it for this lesson. I hope you enjoyed it. In the next lesson, we'll be talking about convertible bonds and convertible bond funds, as well as TIPS and FRNs. Hope to see you in the next lesson. Thank you.